Thanks for joining us this morning, and I just wanted to take the opportunity to thank you for your interest in the company, and let me go ahead and explain a little bit about who WA Kaolin is and what our project is. WA Kaolin purchased some tenements from Rio Tinto in 1999. And since that time, we've been developing the business, and we've funded that business privately through the owners, Alf Baker and Keith Snell and myself. We spent $42 million to date. Of that, about $22 million has been spent on product process, R&D and capital plant. What really sets us apart from our competitors is our resource. We have a primary in situ resource, which has very high brightness and low impurities, which makes it ideal for all kaolin market applications. The resource is also very large. We have an ore reserve estimate of 30.5 million tonnes, and that delivers a 31-year life of mine. We've completed a definitive feasibility study recently that into 400,000 tonnes over the first 4 years of the project. That's delivered very robust economics. And there's significant scope to expand that production based on the inventory of kaolin we have in our resources. We've developed a low-cost process called the K99 process. This delivers a very high-quality, ultra-bright kaolin at lower cost than our competitors. That's because our resource is uniquely very pure, and therefore the processing required can be tailored to that purity. The low capital intensity of the process that we have is based on that purity. We've got a very low cost digging operation. It's free digging, open cut, no drill and blast, a very straightforward mining play. We're located right next to the Asia Pacific market, which gives us very low cost in terms of delivery to market from Western Australia into those markets. And the market is growing at a very good rate of 3.5% compound annual growth rate, based on some third-party research that we commissioned from Grandview Research. Underpinning our economics going forward are offtakes. We have a 6-year offtake agreement with a company called Stanco, who supply materials into the fiberglass industry in China. And when you combine that offtake with some other offtake LOIs that we have with other customers, we've got 83% of our targeted production sold for the first 3 years of production from the project at Wickerpin. Talking about the project, on the right-hand side, you can see our staged approach. Stage 1 contemplates 200,000 tonnes of capacity being constructed out at Wickerpin. That'll cost $18 million and will be funded by the IPO. That's a 12-month build. So that will be up and running before the end of 2021. We then contemplate going to a stage 2, which is another 200,000 tonnes to be added at Wickerpin. That'll only cost $14 million because the sunk capital gone into infrastructure and what have you in the first stage. That'll be funded out of cash flow. And then we have a high road scenario that sees us adding a third stage in year 5, rounding us out to a 600,000 tonnes capacity at that time. Just to talk about the team quickly. You can see on the left-hand side, Alf Baker and myself, Andrew. We are the owners of the business at this stage. Alf is a very experienced engineer with 40 years experience and has built successful businesses over his lifetime. Myself, I have 30 years experience in industrial minerals in the operations and management space. And then we've attracted some very high caliber non-exec directors. We have John White as our chairman. John's had a lot of experience with Northwest Shelf for Woodside offshore gas. He's also was the chief executive for the Pratts of the Visy Packaging Group now. In addition to that, we've added Linton Putland, a mining engineer who's got a lot of experience with a range of commodities in Australia and overseas. And we've got Kathy Moises. Kathy was the head of research for Patterson Securities, actually covered our play for Patterson's in the early days, and then decided to join us on the board and put a substantial stake in herself. In terms of our CFO, we've got a safe set of hands with Michael Kenyon. Michael's been CFO for a number of listed companies and has joined us as well as being currently the CFO for Babylon Pump and Power. I draw your attention to these slides where we're looking at the comparisons with other ASX listed companies who are also in kaolin. We have ourselves, WA Kaolin, we're comparing Andromeda Metals, who have a resource in South Australia, and Subo Minerals, who has a resource in WA. In terms of the size of our resource and reserve, you can see we dwarf the others. In terms of quality, our yield is similar to Andromeda and superior to Subo. And when it comes to the key qualities such as brightness and impurities, which is what the customers buy on, we have a significant advantage. And the comparisons get very interesting when you look at our EV to resource and reserve. You can see that Andromeda has an EV to resource of around $3.20, and we're at about 9 cents. So that's a very compelling picture there. I say comparables, they're not really comparables in that we're an operating business. We have a business running today, and this is a scale-up expansion program for us, whereas Andromeda and Subo are both still in exploration and development stages. Key to our risk mitigation around implementing the project is this staged scale-up. We're scaling up our current plant, which is running at Kwinana today at 5 tonnes an hour. We run about 150 tonnes a week of production through that plant today, servicing our customers. What we're going to do is move all of our production to Wickerpin, which is adjacent to the mine, and that's going to be running at 25 tonnes an hour, delivering that 200,000 tonnes of capacity, as I mentioned. As soon as we do that, we deliver improved OPEX through reduced logistics costs by not having to transport the ore, which contains waste, to Kwinana. That's going to deliver about a $30 a tonne saving to us. And then, as I mentioned, a further expansion to 400,000 tonnes by bolting on another module in year 3. To quickly talk about kaolin, kaolin's a platy white material. It's formed by the degradation of granite over time, and it forms kaolinite and silica. Our process simply removes the silica and delivers the kaolinite to the market. It's a common mineral, but it's very rarely found in high-grade, low-impurity deposits such as ours. It's used in a number of applications such as paper, packaging, ceramics, paints, coatings, fiberglass, rubber, pharmaceuticals, and cosmetics. And there are emerging applications such as HPA, which those who have studied the ASX market will know that there's a few HPA aspirants in the market, and our materials are a perfect feedstock for that. Other emerging applications are metakaolin in concrete. Our material is ideal for use in metakaolin for concrete, and we've partnered up with the Curtin University and the Geopolymer Institute to develop technology around that space for the future. The kaolin market is a very stable market. As you can see, the price graph is very stable over time. We're looking at a very modest compound annual growth rate of 3.3% over the next 7 years, as reported by Grandview Research Report. Whilst that's not exciting, what can characterise the kaolin market is the stability of the pricing. So there's no boom and bust cycles that you see in several other industrial minerals. It's a very low risk play that's got a very stable growth in price. Looking at the markets, you can see Asia Pacific on the bottom right hand side there is the largest market, and it's also the fastest growing in the globe. The global market is $4.76 billion per year, or 30 million tonnes per year. And then you can see the distribution of the various applications there for ceramics, pulp and paper, fiberglass, plastics, and what have you. Talking about the project's located in Wickerpin, and you can see on the graph there, it's about halfway between Perth and Esperance, some 220 kilometres from Perth. We're operating open pits in that location with a very low strip ratio and low mining costs. The life of mine is 31 years, based on our reserve of 30.5 million tonnes, and we have another 535 million tonnes of kaolinite granite in resources in our retention tenements. Those tenements that you can see on the bottom right-hand side, the grey areas are retention tenements. There's 9,000 hectares in those. And the green box is our current mining lease, which we're operating today. That's 998 hectares. All permits and approvals are in place because we are an operating business, and the DFS was completed just a month ago. One of the key features of our mine is its location close to all of the services. We've got services like power, road, rail, access to the town, water, all ideally located for a low-cost logistics chain. I talked about the resource being the separating factor and what differentiates us from our competition. Let's talk about the quality first. It's a primary in situ deposit where the materials have degraded and remained in place. Most of our competitors mine secondary resources or sedimentary resources where those materials are transported into valleys and picked up some impurities along the way. You can see the pictures on the right, USA and the UK. These are mines that are actually depleting at the moment, and there is a restriction on supply emerging in the market. And then Brazil, again, a location there in Brazil opened up about 15 years ago, and that's been one of the most recent additions to the Kaolin market. Now let's talk about the size of the resource. So not only is the quality very good, the size is compelling. When you combine our reserves and resources together, we have 283 million tonnes of inventory. If you take Imerys, who is the largest player in the global kaolin market, they represent 16% of the global market. When you combine their reserves and resources, they've got 250 million tonnes. So in our resource, we have more inventory than the world's #1 player across all of their resources. So that sort of puts into the picture just exactly how big our resource is. Interesting point about Imerys. I mentioned Stanco before. Stanco is one of the companies who've written an offtake agreement with us. Stanco was distributing products for Imerys until Imerys decided to start taking their distribution back in-house. So Stanco know the market very well and are very familiar with the customers. The mining is simple and easy. I don't really need to say much about that. I think the picture speaks 1,000 words. You can see the overburden there on the right-hand side extends from 2 to 9 metres. And then once you get into the ore body, it's very easy to see. It's free dig, easy, low cost, low risk mining. The K99 process that we developed and we are operating today down at Kwinana is unique to us, and it's unique to our resource. Because our resource is so pure, we don't have to go through the chemical bleaching or magnetic separation or the washing steps that most of our competitors use. We use a simple dry process, and you can see there on the bottom the process steps. We extract the material, we dry it in a rotary kiln, we remove the sand, and then we store it in silos and bag it. A very straightforward process. There's no chemistry set. There's no tailings dams. It's a very low risk and low cost, and gives us a real advantage in terms of our cost curve compared to our competitors. The existing customers that we're selling to today, you can see that we've got customers in each of the countries that we want to be in Asia Pacific, and we've got customers in all the verticals that we want to be in terms of market applications, fiberglass, ceramics, plasterboard, and the like. The strategy for us building the Kwinana plant was to de-risk this process. De-risking it means that we had to prove out the business model, and to do that we had to make sure we could produce the right products and win customers at the right price points, and this slide shows that we've done that. And we also wanted to de-risk the scale-up. We're running this project at 5 tonnes an hour in Kwinana, and each module that we install will run at 12.5 tonnes per hour. So the scale up that we have to achieve from where we are today is only a little over 2 times. So that's a very low risk scale up. There are 2 operating modules per stage. So 12.5 tonnes times 2 gives you the 25 tonnes an hour, and that gives you the 200,000 tonnes per annum. Now, we've underpinned these customers with offtakes and offtake LOIs, and we've got 83% of our production for the first 3 years of the scale up, and we get been spoken for with these offtakes. So it's a very solid position in terms of the market. In terms of the owner's outcomes, we've got some equity in the business and some performance rights, and there are royalties flowing through, and we'll have a copy of this for everyone to look at after the presentation, so you can have a look at those things as you like. And let's go through to the IPO. The IPO, we're raising $22 million, 110 million shares, and the offer will be open next Monday. So I won't spend too much time on this other than to say that our market cap will be 56 million. The owners will have about 36%, and the incoming IPO investors will have about 39% after the completion of the transaction. This is our balance sheet. Our balance sheet shows where we're sitting today and what the pro forma balance sheet is looking like. Interesting to note that the company has $23 million of plant that's sitting there that's almost fully depreciated but has considerable value left in it. The other thing to note is that we have accumulated tax losses of $17.1 million. That means that we'll be able to earn a fair bit of earnings before tax, before paying tax as the project goes forward. Just want to finish up here on the use of funds table. The lion's share of the funds raised in the IPO will be going to the CapEx. We did a pre-IPO and we raised some money, and we spent $2 million of that on the CapEx. So another 16 million will round out the $18 million CapEx spend. They've got the cost of the offer, a little bit of debt and working capital. Now let me take you to the timeframe. Timeframe of the offer is we lodged the prospectus with ASIC on the 9th. The opening date for offer is next Monday. We'll be closing the offer and then looking to settle and have the stock listed on the ASX in the middle to back half of November. I just want to, in summary, talk through the investment thesis. I think when you look at our valuation of $1.75 per tonne on an EV reserve versus some of our competitors who are over $40 for the same metric, there's plenty of value there. We have a long life of mine with low CapEx, which means that whenever we earn the EBT, that's going to strongly translate through to dividends. We have a 66% dividend payout policy, and that means that that'll flow through while still being able to grow the business because of the low capital intensity. We plan to scale up to go to 200 to 400 to 600. Going blue sky, going to the forward, we could be up to 1 million tonnes per annum within 6 to 7 years, and that's certainly our goal. It's a low risk strategy that we've set out in terms of the way we scale it up, in terms of how much money we've invested to date to ensure that we've got the market locked away with offtakes. And such a high quality resource is very unique to us, and that not only gives us a premium pricing for customers, but also means that we can have a low cost production compared to our competitors. We've got a highly credentialed team who are ready to go and have to deliver this project, and the owners know the project inside and out. They have skin in the game and with long-term focus, and you can see that they've agreed to escrow of 5 years, so backing up the fact that they are in this for the long haul. It's all about delivering the project now, scale it up on time, on budget, and deliver against those performance hurdles that we have in order to create value for all shareholders.